Why don't we just start real quick with Dee and just introduce yourself to the group, and in 20 seconds, just tell them a little bit about what you do in the business.
Hi everyone, good morning. I'm Chiavaro, CEO of MoneyLion. MoneyLion is a digital finance platform. We write loans directly to consumers, but it's a lot more than that. Our thesis is that 75% of Americans don't have $2,000 in savings, so our loan products help evolve that consumer through a financial journey that starts off with a loan product, a credit score, and ultimately ends up with a asset management product. So we're just launching a robo-advisor, so it's a continuation of our investment in the customer lifetime value of this American middle class, and happy to be here. Thank you.
Bill Ullman, Chief Commercial Officer of Orchard Platform. We provide a lot of data, analytics, reporting, software for the online lending industry. In addition, we just launched our deals platform, a transactional platform where institutional investors can meet with sellers of, whether they're originators or other investors of loans.
Mark Simmer, work within Portfolio Solutions Group at Macquarie. We're a financing provider to the space, primarily principal finance, working with a range of originators as well as their takeouts, funds and asset managers and things of that nature. I know a lot of the guys in this room.
Joey Roth with Prospect Capital. We are an institutional investor. We manage a couple funds, primarily a publicly traded business development company. We are an investor in alternative lending assets. We've purchased just under $2 billion of whole loans over the past 5 years or so. Thanks to the First Associates team for having us.
Brian Korn, I'm a partner at the law firm Manatt, Phelps and Phillips. I'm co-head of the financial services practice. Our offices this is actually the closest event that we've ever had to our office. We're at 7 Times Square, which is right where you see the loft and the counter. I started my career at Sidley Austin, was in-house at Citigroup and Barclays in their equity capital markets, legal and compliance groups. We represent over 100 platforms, institutional investors, and investment funds, both onshore and offshore, in interacting with this industry. We work with platforms on regulatory compliance, consumer and small business licensing issues, as well as financing, equity, and leverage transactions, and with funds on fund formation issues and dealing with the regulators.
Great. Thanks, guys. So let's jump right in. So in May of last year, we had a little bit of a correction in the marketplace lending space. We're seeing consolidation. We're seeing some folks that haven't been able to make it. We're seeing some of the equity drying up. Okay, let's just start with Dee, and talk about the topic. What's the state of the industry today?
Sure. So we operate at the top of the funnel. So our thesis has to be with equity investors that we're able to profitably interact with consumers. As we evolved, we wanted to make sure that our assets were profitable. And as we evolved as a company, we realized that the equity investors are looking for platforms that can give them venture capital-like returns. How do you do that with a financial services company? It's very hard to do that. So if you think about why we've made investments in the product, half of our company works on product. Our mobile app now has 2 million users, and only 5% of those 2 million users actually take loans from us. But we have to make those investments to show equity investors that there's a customer lifetime value that's a 5-year conversation. So if you look at our roadmap, we started with short-term loans, then we added up medium-term loans, long-term loans, free credit scores, asset management. You'll see a MoneyLion bank account next year in 2018. You'll see a 401k product. And that's the conversation that we have to have with equity investors, that, hey, this is something that you can 5x or 10x your money with. And without that, it's very hard for top of the funnel participants really to attract equity capital. So it's incredibly hard, incredibly challenging, but we have to make money for both the lenders as well as the equity investors.
And Dee's platform is doing extremely well, and a couple of his debt providers are in the room here today as well. And so thanks. We've been working with them for 3.5 years now. Bill, you're seeing it from all angles. You guys have changed up some of your models. You're in the secondary market. I mean, what are you seeing today?
I'm supposed to give a little talk tomorrow at the conference, and one of the themes of the presentation, I'm just going to step away from Orchard for a second. I've been in the financial services business for a while now. I think convergence is the big theme and thing that I've been thinking about over the last year. And by convergence, I mean the old world and the new world converging together. I think what Dee has done is spectacular, but it is a challenge to build, in particular, a retail brand, or as Dee described, the top of the funnel, and compete against very deep-pocketed institutions out there in the marketplace. And so there's going to be a limited number of platforms that succeed there. And I think we've watched now over the last year or two as, you know, JP Morgan, Goldman Sachs, others have in various ways either building it or partnering, or, you know, through other companies outsourcing this online lending to others. We're seeing them get involved, and you know, if you look at other industries out there, in particular in financial services, in the past where the internet has collided with traditional financial services, what happens is there's some winners that are independents that break through, build brands, build real businesses, provide incredible returns for their investors, whether they're debt investors or equity. And there are others that go out of business, as you've been mentioning. I think that process, that shakeout continues. And then there's the traditional players that come in and either acquire or partner. And I think that process now is sort of underway, and I think we have to watch how that plays out.
And thanks for that. And Mark, you know, where a lot of the, you know, the larger banks have kind of dipped their toe in, some have gotten out, many have gotten out, some have stayed. You guys took a little bit of a different approach without revealing any proprietary info here. I mean, what are you guys seeing? Obviously, you're seeing something different. You guys have been really active in the space, done a lot of transactions. You know, what are you seeing?
Well, I think, you know, as people have over the last couple of years, people started to view these companies a bit differently. They started off with a lot of VC investment, a lot of people believing these finance companies were going to be $1 billion, $2 billion, $10 billion companies, and what we've seen over the last year is a retracement of that, and with that we've seen a lot of private equity money start to take a longer look at the space, because a lot of these companies, especially the niche players, if they have good sourcing channels, if they found themselves in a position where they don't need to generate $20 billion of loans a year to be profitable, they need to generate $300 to $500 million. That's a private equity product, and if they have a strong presence in a niche, we're seeing private equity move in. Private equity also realized it's a little bit of a cost of capital game at that point. You know, so where we've been seeing a lot of activity is our niche spaces. A lot of times it's point of sale. A lot of times there's a specialized part of the market that these originators are playing in, and it's private equity that's coming in to finance it. And so that's where we've been seeing a lot of activity on the originator end. On the marketplace kind of loan sale, and those typically they retain their loans. If the platforms are selling the loans, we've seen a lot of consolidation. The big players have scale, they have access to markets, and you know, it becomes very difficult to compete against them. And so in that area, I think we're seeing a little bit of a culling of the smaller players. That's probably going to continue. We'll probably see some more consolidation, and in that space, the way we view it is these players are going to move into they're either going to disappear, depends what's wrong with them, or they're going to move to, if they have a good core, if they have good technology or good sourcing channel, good team, they'll move into a stronger player, and that player is going to need cost of capital advantages, and so that's where we see ourselves coming in. Let's help the people that are going to survive, and let's work with the niche players that are seeing themselves as more specialty financed.
Great, and thanks for that. And Joey, we've been working with you guys for 4 years. Thank you for your business. You guys are continuing to grow. I'm going to get into securitizations, kind of the next piece there, but you guys are constantly, you know, the leading funds out there that are buying whole loans. You must be seeing something different.
Sure. Yeah, I think I think as Dee and Mark mentioned, what we look for is really a bottoms-up analysis of the unit economics of both the assets that the company is originating and the business itself. So I think one of the problems we've observed is companies selling assets where the business model itself is not yet profitable. And I think there's been a big focus on profitability over the past, maybe 12 months or so, which in some cases is good for investors like us. We're looking to buy whole loans. It doesn't necessarily mean there's more more assets available. But what it does mean is that the market is entering more, a next step of maturity and the evolution where at the end of the day, the businesses that are originating assets need to be profitable. So I think that's important for us when we're analyzing opportunities. Whether a business is selling assets or retaining them on balance sheet, we really want to make sure that the business is on solid economic ground. And to your point, Larry, I think over the past 4 or 5 years, we have definitely picked our spots within the broader marketplace lending space. And we've identified certain strategies that have been more profitable for us than others. We continue to see attractive opportunities, but at the same time, we are, we understand what type of macroeconomic environment we're in right now, and we factor that into our analysis as well.
Well, I know we've had a conversation a few years ago, and you guys at one point had looked at like 30 or 40 platforms. I mean, how many do you, without revealing, I mean, is it a handful that you're buying today, or is it 30 or 40 that you're buying loans?
Yeah, it's a very short list right now. We try to understand, who has differentiated channels of origination, as Mark mentioned. Ultimately, who is correctly pricing and underwriting the assets, and who is equipped to service the assets. So we go through, pretty comprehensive due diligence process, and there have been at different points in time over the past several years 30, 40, 50 platforms out there looking for capital. We have only selected a handful over the past several years.
Great. Switching to Brian. So every once in a while I get a call or email from Brian that says, hey, I'm sorry to tell you, but my client X is no longer originating. What do we need to do? And what are you hearing from somebody?
And you say, why didn't you buy the First Associates Tier 1 package?
Yes.
So I think there are a couple of themes that come out of that. One is there's a lot of consolidation right now at what I would call sort of the sub-lending club on deck cabbage levels. The platforms that were very entrepreneurial in 2014, 2015 have sort of decided, not hit a wall, but they're really, they either have to scale up and get originations or they have to collaborate and consolidate with a bank. We've seen banks step up, both the large banks. Goldman did a portfolio acquisition and an employee acquisition. They basically acquired everything except the legal bills of Bond Street. But I think we'll see more of that. I went to a community bank conference where people ran up to me throwing business cards in my face because their antennas are tuned. They realize technology is the way of the future. They see real collaboration opportunities with fintech because they have customer base, they have lower cost of funds. Fintech firms have the efficiencies, and the question is, will they find partners and marry themselves up? A lot of community banks are concerned that they're going to die. The second thing is what are your cost of funds? If your cost of funds are too high, or you're being throttled by a hedge fund type lender, not to disparage anybody, but it's very hard to get to profitability when you're paying your cost of funds at 13, 14%, plus warrants, plus other equity, plus you can only originate within a certain credit box. And then finally, the other things I've noticed is that the equity check is still pretty hard for these guys. I was at meetings on Sand Hill Road, and they're very skeptical of this industry still, except if you're one of the established players. So I think we're seeing maturity of platforms where those who have gotten the big investments, either the Asian investors or those from U.S. firms, seem to have a lot of runway and path, but those who are looking I was in a conversation where a portfolio manager said, are you a tech firm or are you a real estate firm? Are you a tech firm or are you a financial services firm? And the answer to that question, regardless of what the financials look like, really guided where their source of equity funding. But equity funding seems to be a very slow process right now, and I think it's obviously necessary because of advance rates and other things from lenders to keep the machines going.
Let's just jump into securitization. So, we have some guests in the room, John and Steve, who did the first marketplace lending securitization somewhat 5 years ago. Then we were involved in the first rated transaction with BlackRock. And now most of the platforms are shifting gears, right? And so where Joey, where you guys did some securitizations, now you're working on shelf with a lending club or on Prosper's deals. What is the advantage of that from Prospect's point of view today?
Sure. I think from our experience, we did one securitization that we organized at Prospect entirely with our collateral, and now, as Larry stated, the platforms such as Lending Club, for example, are organizing securitizations on behalf of loan purchasers. I think the advantage to that sort of shelf program is scale, where at any point in time the platform is able to aggregate more assets into a particular deal than any single individual buyer would be able to. We go back and forth from time to time about who has more leverage in terms of working with service providers and negotiating the best deals, but we do believe that there are benefits to the platform organizing the transaction. I think from the ABS buyer perspective, if a bond is under the same shelf, it might be different issuances, but the market starts to understand that shelf and that structure as opposed to having many different deals out in the market at the same time. So I think it has brought a little bit more certainty of timing, of execution, and just of capital structure and terms that makes it a little easier to execute. And so we've participated in those deals and we'll look to do so. And I agree, that seems to be the way the market is shifted.
And all of them are being rated today, sometimes by two agencies. Is that helping execution for you?
I think it's definitely helping execution. If you look at our first deal compared to where the market is today, and it's only been 12 months, the execution, the liquidity, the depth of the investor base has increased significantly. So we've been happy to see that.
Dee, any plans to securitize as you guys continue to grow?
So our duration of our loan product is slightly on the shorter side. So as we look into 2018, second half of 2018 and 2019, it's certainly where we want to end up, but we're not there yet from our just from the product mix perspective. But it's certainly where we want to end up.
Okay. And I want to ask Bill a question about the secondary market that you guys are creating at this point. Others have tried over the years, all unsuccessful. With this consolidation, with some of these acquisitions going on, where does the secondary market stand today?
There are trades that go on. Most of them go on away from Orchard. And I don't think there's a lot of really good data on how much actually takes place. What I can tell you is there's still a healthy bid-ask spread in the market. We have a bunch of deals on our platform today that investors are looking at that are true secondaries, one investor owning a pool trying to sell it, and the owner's view of the value of the pool is quite different than the potential owner's view of value. And how do you solve that? Getting everyone on the same page in terms of the data and the quality of the loan pool, I think, is critical. But also we have issues like valuation providers in the market that may be using a methodology that is different than the way a potential hedge fund or buyer might look at that pool. And that creates problems as well. And then you get the issue of, well, I don't want to mark down my portfolio now. I just told my investors, it was here and now it's down here. That's not helpful for me. I'd rather wait and delay that. So I think we've got to eliminate that spread, but there are sellers, and I would say distressed situations will create more of a market. When you have forced sellers, buyers love it. we're going to like it. I think it'll work
Gotcha.
better.
I want to ask Mark a question in regards to underwriting, because I think it's important while we have, and we could probably do it on for 2 hours, but I'm getting a 5-minute sign in Rose. So Mark, there's a lot of off-the-shelf underwriting software that these folks use. Right? When you are looking at a platform and making an investment, how big does the underwriting model come into play?
It's important. I'd say kind of 2 years ago it was of paramount importance. We've come to realize over the last couple of years that the underwriting model is only a small piece of the equation, and then how that model is applied also can vary significantly in ways you can't really tell. So we found a pretty big dispersion of underwriting models with successful platforms. You've got originators like Dave who are very tech-enabled, very advanced in terms of what they do from an algorithmic and machine learning standpoint, and they're successful. But then you have guys that use scorecards. They're 1980s originators with a good sourcing channel, and they're producing some of the best loans out there. So we've come to appreciate the range of possible approaches that can be successful, and also just it matters where your borrowers are coming from and what you know about them, and that's potentially the most important thing. But I think again, you're seeing originators like D and others expand the scope of where they're getting their borrowers. It's not direct mail, it's not lead gen. We're going to create a wealth management app so that now we have kind of a life cycle relationship with our borrowers, and we know more about them now, and they're going to have a better relationship with our company. That matters, and that's not part of the underwriting model.
Gotcha. I want to ask each panelist. We'll just start with Brian as we start to wrap here. What are your predictions for the end of the year? We're November 1st already, believe it or not. All right. What do you see for the rest of this year and heading into 2018?
So just putting my legal and regulatory hat on, I think that we're in a very static environment, actually. There isn't a lot of momentum in Congress. I'm not sure that anything will be accomplished with respect to marketplace lending from a legislative perspective. There's a bill pending right now to effectively validate the valid when made model, but there's no sign yet that it'll be included in whatever the tax proposal will be or in any other legislation. So we still have Manatt as an overhang. In New York, investors are not interested in loans that are north of the 16% usury cap. In Connecticut, it's 12. In Vermont, I think it's 12 also. So that's a constraint on lending in this area for sure. We have a CFPB that's under pressure from Congress. We have a new director that will start, if Cordray doesn't resign, his term is up next July, so that'll be interesting to see the direction of that agency. And then finally, the states are getting more aggressive. We've seen Colorado go after Avant and Marlette, where WebBank and Cross River have done preemptive strikes to try and fight the battle there, as opposed to having every state bank commissioner call the model a sham. We've had a few victories in the state bank partnership model, the Beecham case in California. We've had the Bethune case thrown out where mandatory arbitration's been upheld. We had Congress disallow the CFPB counter to that, which was going to allow mandatory arbitrations, and the Congress passed a law saying they could undo regulatory rulings within 90 days, and then the Senate, you probably read last week or the week before, Mike Pence cast the deciding vote to kill the CFPB mandatory arbitration rule. So all of that leads to a very static environment. The one wild card, I think, is the New York State Bank Commissioner. I heard Maria Vullo speak a few weeks ago. She does believe that the industry needs to be regulated by her and that everyone needs to sign up and get licensed. It died this year because of lobbying activities. We'll see if it happens again next year.
Great. Joey, what are your predictions for next year?
Sure. I think consistent with kind of Brian's description of the regulatory side, we generally expect performance to be pretty consistent with our expectations. I think, as Larry mentioned, in 2016 we saw a lot of changes in this market. We've sort of re-underwritten all the assets that we're purchasing right now. I think we've reset expectations, and from our perspective, we're expecting the rest of the year to be pretty consistent with how we're currently viewing things, and we don't anticipate any major surprises.
Mark?
Yeah, I'd agree with that. We'll see the large originators probably continue to scale at responsible rates, and I don't think we're likely to see something like we saw in 15, early 16, where people go over their skis on underwriting. I think everyone learned their lesson, and it's going to be much more measured if people are going to push the buttons.
Bill?
I go back to what I said earlier on, which I think we're at the beginning of this phase of the consolidation, the shakeout, and the convergence of the new lenders with the old world. I think that will continue this year.
D, from a platform standpoint?
Yeah, so there's massive amounts of innovation that's happening on the top of the funnel. We're seeing traditionally non-lenders come into the space. So Google, Facebook, Amazon, Uber, Lyft are all coming into financial services in various different ways. Uber launched a credit card last year. So we're seeing an expansion of the competitive set that we have to now worry about going after our customers. Our customers broadly are defined as the 138 million Americans that self-identify as saying we struggle with finance. What we'll see for the marketplace lending space is with all of this innovation, there's a target addressable market expansion where you can actually charge lower interest rates for a much bigger part of the universe, because you're effectively collateralizing that loan with some of the other platform services that you're providing, whether it's Uber's providing car rides, or platforms like ours are providing free identity theft and monitoring. So can you earn economic rents from other products? That bundling of financial services is happening in front of our eyes. There are incredible companies in Silicon Valley like Active Hours that don't even charge an interest rate, that are raising massive amounts of capital. So in 2018, we'll continue to see innovation come back into certain parts of the market as well.
Gotcha. The last question I have for the panel, they'll be here for a few minutes. We don't have to give up the room. And so if you have questions, please come up and say hello and chat. I'll start with you, D. Next year, 2018, volumes are up, down, or stays the same?
We're predicting them to double on our platform.
Okay. Bill?
Up.
Mark?
Yeah, up with also significant growth in product mix.
Joey?
Up.
Brian?
I think
We have some press in the room, so you can report that the consensus for marketplace lending is we believe that volumes are up. Thank you very much. Thank the panels for some great insight. We could be here for 2 hours if we had. So we really appreciate you guys taking your morning to share with our clients and friends. Thank you.